Good morning, good afternoon, everybody, and thank you for joining us here at the Climate Bonds Connect 2022 conference, the first time that we're hosting this event in a hybrid format. So hello to those of you joining us in person from London and to the rest joining virtually across the world. My name is Krista Tukiainen. I'm a senior advisor to the Climate Bonds Initiative, former head of market intelligence with CBI. And I'm pleased to be joined today to discuss the exciting developments in the climate finance by our partners, Asian Infrastructure Investment Bank and Amundi Asset Management. Calvin Kwek and Timothy Jolan. I'm hoping I didn't butcher either of your names there. Gentlemen, pleased to have you here with us today. Would you like to say a few words to introduce yourselves and your organizations and the topic that we're going to be discussing today? Calvin, maybe we can start with you.
Thanks, Krista. Thank you for hosting us at this conference. Today, this conversation will be about the launch of a very exciting piece of research that we have worked with other program partners. Just step back a little bit. My name is Calvin Kwek, and I'm an environmental specialist working at the AIIB. And over the last 3 years, I have been working with the team internally and also with our colleagues at Amundi and also with you, Krista, at CBI, on the AIIB-Amundi investment framework, which was actually launched 2 years ago. Our discussion today will be about some research applications which have used the climate change investment framework as the overall organizing intellectual framework. So I'm very happy to be here.
Great, thank you so much, Calvin, for that introduction. And Timothy, over to you.
Thanks, Krista, and likewise, happy to be with you all. So my name is Timothy Jola. I'm heading ESG Business Development and Advocacy within Amundi.
Great, thank you very much. Maybe to both of you, to kick us off, Calvin alluded to the climate change investment framework there. Could you talk to us a little bit about what the framework is and how it came about, given that it was a collaboration between your two organizations and also with some input from the other program partners that you mentioned there, Calvin?
So Calvin, do you want me to start on this one and then perhaps you can follow and complement on the specifics of the framework?
Sounds great, Timothy.
Okay, but perhaps just to take a few steps back to reflect a bit on the convictions that we shared between partners, both on AIIB and on Amundi's side. We all very well know that the world still falls short of doing what needs to be done to meet not only the 1.5 degree objective, but also the well below 2 degrees objective. And we know what are the reasons for that. There is an ambition gap, there is a policy gap, and there is a financing gap. And what is a very firm and deep conviction of Amundi is that we cannot be a substitute for governments and policymakers. That said, we are very, very cognizant of the fact that the private sector, capital market participants can play a key role. They can play a key role in not only reducing or coping with the financing gap, but they can play a key role as well in helping to meet the ambition gap, because what we have observed over the years is that there is an ambition gap, of course, coming from the countries, coming from governments, but there is also an ambition gap coming the private sector. And clearly, whenever the private sector shows leadership, it helps government to do the right thing in terms of closing the policy gap. So private sector needs to play a key role, and capital market participants can play a key role in not only closing the financing gap, but also closing the ambition gap, because they can influence companies and market participants can engage companies. So that's the first conviction. Second conviction, why we need not only to focus on private sector mobilization and capital market development in developed market, but also in emerging market, for a very simple reason. It's the area where over the recent years GHG growth emission has been coming from, and this is probably where it will continue to come from in the next few years. That's due to a very simple reason. These are the areas in the world where we still find, let's say, significant growth. And this growth is still very much CO2 intensive. And so to solve at the global level the climate challenge, we need to make sure that growth in emerging markets and developing economies start to decouple, meaning that we'll continue to see economic growth, but we will see gradually CO2 intensity lowering down and absolute GHG emission starting to reduce. So we need to focus on private sector mobilization. We need to focus on sustainable capital market development, but we need very much to focus doing so on what's happening in emerging market. And with AIIB, we were lucky enough, since we share this conviction, to focus on the specific case of Asia and other target countries. And this is really one of the most critical area in the world because it's a fast growth area. It's also an area which is very much exposed to the physical risk linked to climate change. It is estimated that around 20 to 25% of the global Asia GDP could be impacted by a physical risk coming from climate change. So this is really a critical area in the world. The last bit, and that's the third conviction we were sharing with AIIB, was that use of proceeds bonds, meaning green and sustainable bonds, are a very useful and powerful tool when it comes to mobilizing private sector and capital market participants, but it will be efficient if and only if there is additionality, meaning that it is a tool as well that enable the ecosystem to see private sector companies evolve in terms of their overall climate strategy, in terms of their energy transition pathway. And a green bond is a useful tool if it enables the company to speed up that transition. And that's the reason why we worked with AIIB on a program that would not only support issuances of use of proceeds bonds, but also take into account at the corporate strategy level how the corporate fared vis-à-vis key climate transition dimensions. So on this note, Calvin, I will stop here and let you provide additional information on this framework and what's the way forward.
Thanks, Mateo. It's a great introduction. It's great to also remind ourselves of the genesis of the work that we've done together between our two institutions on this framework. I think I would add two other points as well. First of all, working with Amundi, AIIB created this climate change investment framework, which is intended to be a tool that investors can use to assess the performance of companies or issuers or sectors and so forth. As part of the launch of the framework, we had at the time 2 years ago also got into agreement with Amundi where they would actually manage on AIIB's behalf a portfolio of bonds that will be rated according to this climate change investment framework. So sort of a real life case study of the framework in action. And that third pillar that I think we really wanted to try and test ourselves was to put the climate change investment framework to the market, right? As you recall, we launched the climate investment framework, and then we also asked 3 reputable organizations to look at the framework and to test it. And how would they test it? To apply the framework towards 3 sectors. So working with CBI and Amundi, we asked 3 renowned organizations to apply the climate change investment framework first to sectors. We asked Fitch to actually use the climate change investment framework and apply it towards the analysis of sectors. We then asked Carbon Trust to apply the framework and use it towards the analysis of companies. And we asked CBI, the Climate Bonds Initiative, to apply the framework towards the analysis of issuers. And we're very happy that after quite a bit of time and quite a bit of work, we are going to be launching this research at the CBI conference this year. So perhaps what would be a nice segue as the next level of discussion would be for us to perhaps discuss a little bit about more about the research paper. Krista, perhaps you were the overall project manager for this research paper. And any sort of additional introductory comments about this paper?
Yeah, thank you, Calvin and Timothy, both for that genesis. Indeed, good to be connecting the, how far we still have to go in the real world to the research application, which actually I would say, to give a little bit of a teaser of the results, they do mirror the gaps in terms of the funding needs that are still to be met, especially on the physical risk and adaptation and resilience piece, which we can talk about in a moment in terms of what those findings look like. I'll just say that for me personally, and for the consortium of organizations that were working on this piece of research for the better part of the last 2 years, what was quite interesting was that the framework itself is comprised of 3 objectives which mirror those of the Paris Agreement. So we've looked at not only the mitigation aspect, so how organizations at the sector, individual company, and then debt issuer level are doing with regards to getting their sort of net zero targets in place and getting those emissions to start going down, at least in a trajectory kind of fashion, but also how they are in practice contributing through their activities, operations, business models, and changes therein. And then finally, how they're starting to come to grips with the staggering risk, which you alluded to, Timothy, just there. Was it nearly a quarter of Asian GDP that might be at risk from the physical and kind of myriad, let's say, impacts of climate change? And I'd certainly say that that finding, the sort of headline finding of we're still a little bit further behind on that last point of adaptation and resilience is coming through from across the research at all 3 levels. But then conversely, we were very pleased to see that companies, even in emerging markets and so on, are very attuned to the transition risk piece and are starting to really manage this in quite sophisticated ways. So there are investment opportunities in these regions, in these geographies, for investors who are interested in real world impact. And as Timothy said, a part of that is labeled use of proceeds bonds, and a part is unlabeled debt volume from companies who are just making or embarking on the journey towards net zero and a resilient economy. So I'll stop there, and then Calvin, maybe hand back over to you to talk a little bit about the findings from your perspective, given the sort of, you're the folks that sort of started to think about these topics from a framework perspective, and then convened this brilliant consortium of organizations. What do you see as the headline findings, if you will, or the most exciting pieces that have come out of the research for you?
Sure, thanks. So, well, what was interesting was that conceptually, I think there was quite an elegance in terms of the CCIF framework, the climate change investment framework, aligning itself obviously with the 3 pillars of the Paris Accord, right? So performance according to how well companies were mitigating the transition risk, how well companies were adapting to the physical risks of climate, and also how well companies were contributing towards a transition towards a green economy. And so when we presented this to Fitch, and then to Carbon Trust, and to the folks at CBI, Krista, where you're at, we actually found they actually came back with slightly different ways in which they applied the framework. So I'll give you an example with Fitch, which was involved in the analysis of sectors. And they looked at 8 sectors: automotive, basic industries, healthcare, telecom, energy, technology, utilities, and transportation. They found it necessary to actually add another pillar besides the 3 pillars which I just mentioned. They thought it was actually very important for financial capability to be added as a pillar in order to assess how real the company's capabilities were towards transitioning to green, right? So it's one thing to say or to have numbers to show whether you're doing well in mitigation, adaptation, or contributing towards climate change reduction, but they also want to see a strong balance sheet. They also need to see, good corporate earnings and so forth. Even if they also argued as well, at least in their research, that those two are self-reinforcing. A strong balance sheet would allow you to transition, so obviously, but at the same time, moving towards green, adapting towards the physical risk of climate change would prevent you having to deal with unnecessary risk, and obviously would then strengthen your bottom line. That was quite an interesting analysis, observation that came out from Fitch. If I can jump quickly to Carbon Trust. Now, Carbon Trust was very focused on companies. They interviewed 8 to 10 companies, I believe, in Asia, also along those same sectors that I just mentioned. And because they had one-to-one direct connections with these companies, they actually interviewed these companies and went beyond what was actually reported by the companies, right? So as we all know, reporting, particularly on adaptation at a corporate level, is still quite an emerging market. And so it was only through sort of individual interviews with these companies that we got, or these Carbon Trusts got to see some of the interesting things that companies are doing to respond to the physical risks of climate. Now, obviously, there's a selection bias at play. I mean, companies will report what they sometimes like to report, but it was also really interesting to see sort of the connecting tissue between sort of their work to mitigate their carbon emissions and how they're adapting to the physical risks of climate. I would probably now like to invite you, Krista, if you don't mind. You've done actually some work to look at how the climate change investment framework was applied towards issuers of bonds and green bonds. What did you find?
Thanks, Calvin. It's really helpful to sort of get the overview at the various levels. And indeed, as it says on the tin for CBI, the approach was always centered around bond issuers. So this is work that we've been doing for more than a decade now to look at what the potential of the debt capital markets is with regards to mitigating and more recently adapting to the effects of climate change. So the approach that we took to the application from a research lens of the CCIF was to start from companies within emerging market Asia geographies to look at which of them are already contributing to climate change solutions through their revenue streams. So we started from that as the kind of broad filter to narrow down the potential ultimately investable universe, but in this case, the research universe. And we ended up with close to 500 issuers, 483 issuers in total from 33 distinct geographies. And we found that there's close to, or actually just above $600 billion equivalent of bond issuance from those issuers outstanding already, some of which is labeled green, sustainability linked, etc., and some isn't, so just plain old vanilla bonds. we then started to dig a little bit deeper. So this is sort of work that Climate Bonds has already been doing for many, many years, and updates every year. But within the sort of spirit of the framework, if you will, we wanted to also look at all of those close to 500 issuers, transition strategies, and strategies around adaptation and resilience, if those exist. And we found that, as discussed before, the vast majority of the companies that we looked at were way ahead of the curve in terms of mitigation strategies vis-a-vis adaptation and resilience. And indeed, none of the sample had all three objectives down in terms of contribution, mitigation, and adaptation. Some interesting outcomes also in terms of where specifically which geographies companies are based in. So we looked at applying an external database and a framework from the Notre Dame University in the US, the ND Gain Index, to sort of understand the risk exposure, the physical risk exposure to climate change, and also applied that as a filter to see where companies might be less exposed and where they might be sort of understanding their risks a little bit better. So some interesting findings therein, but I would like to sort of reinforce or re-emphasize the point that there were quite a few issuers, and we obviously talk about the statistics and dig into the findings in the main paper, which will be made available, I think, on all three organizations' websites in due course, and obviously distributed to our partners as well, to sort of slice and dice the investment opportunities there in much greater detail. So I'll stop there for now. Calvin, was there anything you'd like to add on the sort of teaser of the findings, if you will, before we conclude our discussion today?
Perhaps I can chime in here a minute just to share with everyone why we think, as a global asset manager, and especially one who cares about sustainable finance development within capital markets and in EM in particular, because we think this study actually provides or help us to address very significant information gaps on the market. And as you know, information is really, really critical if you want to really continue developing the sustainable capital markets in EM. First gap, integrated approach towards climate change mitigation. Usually this is covered, but also the other dimensions. And from the perspective of an investor, the other dimensions are as critical as climate change mitigation. So I'm talking about mitigation, resilience towards the risk which are already materializing. It's not in a far off future, it's already there, but will continue to increase, unfortunately, in the coming years. And of course, contribution to low carbon transition, the ability to also benefit from a corporate perspective from this transition by developing and distributing solutions. So that's one, integrated approach. Second, sector transition pathways adapted to emerging markets. We have seen interesting development in that particular research field, but very few concrete and developed pathways which are adapted to emerging market and developing economies. And this is really a first in terms of level of ambition in that particular dimension. Third, of course, additional analytics and interesting KPIs in terms of market depth and market development. And if we want to grow sustainable capital market as an asset class, be it in terms of use of proceeds or issuance by leading companies in the private sector, this is also what we need to have. So from the perspective of a global asset manager, and I say it not because only we're a partner, we are very, very excited by this research. And really, I encourage everyone to read it as soon as it's out, because it will contain very important information if you want to position your institution in that space from an investor standpoint, but also from an issuer and market participant standpoint.
That is an excellent way to round out the conversation. Thank you, Timothy. So to take away from this discussion to everybody, read the paper when it's out and think about integrated climate strategies. I like that phrase a lot. There's a lot to do, even with those companies, issuers who are already contributing to both benefit from and make sure that we can manage the sort of moving goalposts of climate risk across the three objectives of the Paris Accord. I'd like to say thank you to you both. If you have any closing words, we can certainly happily listen to those. Otherwise, we'll wrap up the discussion and again say thank you to the audience for tuning in and for joining us at Climate Bonds Connect 2022.